So you've been looking at retirement accounts and your head is spinning because there's IRAs, there's Roth IRAs, there's 401k, even the Roth 401k. And it's a lot. Yeah, there's a lot out there to figure out. And all you want to do is kind of save money and make good decisions over time and have a lot of money in the end, right? Well, there's a lot of details. So let's get into what is the best maybe for you and some pros and cons of different types of accounts, why we save in retirement accounts in the first place. Hey guys, I'm Tyler. Let's jump into it because I want you to have the amazing retirement and the amazing future where you have tons of flexibility and tons of money. So let's start with just why we save in retirement accounts versus like a bank account. So I pulled up bankrate.com. It's a really popular website and it lists bank accounts and interest rates you get at bank accounts. So the first thing we'll say is, okay, this is as of today, January 19th of 2023. The big banks, Wells Fargo, Chase, and Bank of America, you'll notice what they're paying in interest is less than 1%. It's a lot less than 1% on these savings accounts, right? So generally, that's a really good place for an emergency fund, but it's not great if you really want to expand your money and grow your money over time. Of course, there's always risk of loss if you're taking money and putting it in investments, but banks really don't pay you much of anything. So that's the first thing is we don't want to put our long-term money for 30 years from now money into an investment or a savings account that's getting 0.15, the best of the group, with Wells Fargo. Let's look at some other options. And why I say that is because here on this next slide, we can see if we just started with $10,000 today, and then you just added $10,000 per year over a 30-year period, okay? So here we are, we're saving for 30 years plus the $10,000 initial investment. So our full investment is $310,000 that we put in. And at 1%, which is actually a lot better than the 0.15 that Wells Fargo, the best on the list, was giving us, you would have $337,000. In other words, really meager growth over that time period, right? But if we just got 5% on our money, that turns into $740,000 over 30 years. And hey, if we got 8%, which realistically is actually a good target long-term for a balanced portfolio, you're going to realize almost $1 million more than if you had only gotten that 1%. So 1.3 million versus 337,000. Big difference. And you can kind of see that exponential growth. So we want to invest for the long haul, which means taking some risk. It doesn't go up in a flat line, but if we can average 5% or even 8% long term, it turns into a lot more money. So we're not going to put it in a savings account for retirement accounts. We're going to try and get a little bit better yield over time. So the next thing we want to look at is, well, one huge reason why we don't want to put all of the money always in a brokerage account, we do want to put it in retirement accounts because retirement accounts give us tax efficiencies. The federal government, the IRS, gives us some tax breaks essentially for putting money into retirement type accounts. So the big thing there that we want to think about is, okay, if you're putting money into an IRA, that can be pre-tax. If you're putting money into a Roth IRA, that can be tax-free distributions in retirement. But both types of accounts, all types of retirement accounts, IRA, 401k, Roth IRA, all grow tax-deferred. And because they grow tax-deferred, the government doesn't get pieces along the way. And that, when they get pieces along the way, that's kind of called tax drag. So here's a chart. We've just said, okay, money over time, your cumulative balance over years. And it's a really simple thing to say, hey, if you have investments over time, they're going to compound on themselves and grow on themselves, and it's going to go up. But on the second category, if you have a little bit of taxes taken out over time, you're not going to have as much in the end. So this is the tax effect. So tax drag. So we'd rather be up here, and how we get up there is by owning, investing, and putting dollars to work in retirement type accounts. So here we go. What does that mean, Tyler? So retirement type accounts, the first thing is there are contribution limits. There are rules around how you can take the money out. Either you have to take the money out at certain points, and you cannot take the money out before certain points. There are lots of rules. And there are penalties if you wind up breaking those rules. So the first thing let's look at is, okay, IRA, Roth IRA, 401k, how much could we put in? So here's a chart we have. Traditional IRA and the Roth IRA are identical. So you could put $6,500 in each of those traditional IRA or Roth IRA. There's an asterisk here though, because you have to have earned income to be able to contribute to these accounts. And that, as you can see, is less than 50. If you're over 50, you can do an extra 1,000. So total, you can do 7,500 into either the Roth or the traditional. Keep in mind, this isn't both. You can do either or the Roth or the traditional IRA. Asterisks again, the Roth IRA, there are income limits that we'll get to in a minute. And then here's a 401k. So a 401k or even a Roth 401k has bigger contribution limits. So this is through your employer doing a salary deferral, and you can put up to $22,500 in 2023 into your 401k. And if you're age 50 or older, you can do another $7,500 to get a full $30,000 into your 401k. And that's before any employer match. That's before any employer profit sharing. So $30,000 plus any employer match, you could wind up getting $35,000, even $40,000 a year into your 401k. In addition, you could do another potentially $7,500 in either a Roth or a traditional IRA. Pretty cool. All right, so here we go. Let's just start with how a traditional IRA works. And I'm just going to draw a bucket because all these accounts are essentially just that. They are accounts. We're not telling you how we're going to invest this money. Once the cash is in the account, that's a separate decision what you want to invest it in. Really, the traditional IRA here, we're just talking about how it's taxed. So a traditional IRA, money goes in, but it is pre-tax. What that means is, let's say you put $5,000 in a traditional IRA and you made $100,000 this year. Well, you're taxed as if you've only made $95,000 because that $5,000 went into your traditional IRA and it's pre-tax money. So $5,000 goes in. Let's say we have a good year and it grows by $1,000. That'd be a great year. Not all years are good. Some years are bad and they go down. But let's say we got $1,000. So now we have $6,000 in there after the year. And let's say it grows and compounds and then goes back and then grows and compounds. And potentially at the end you have a lot of money, right? Well, in the end, when you're ready to retire, and that's my little spigot. Here's our spigot. So again, the age to take it out, there's a rule here, 59 and a half. So you cannot take the money out without a penalty. There are exceptions, but generally you can't take the money out without penalties before 59 and a half. But since you did not pay taxes on the way in and you did not pay taxes on the growth, over time, as you take the money out in retirement, at that point, you'll be taxed and then it's your money. So a lot of people say, oh, well, save the taxes while you're working, and then when you're in retirement, potentially you might be in a lower tax bracket because you're not working. So that's the idea of save taxes now, save taxes along the way as it grows, but then pay taxes in the end as you take the money out after 59 and a half. Keep in mind their distribution rules. Actually, they just recently changed. It used to be 72. They just raised it to 73. And those are going over time going to be up to age 75. So just pay attention to when you have to take money out. And there's a bunch of rules and exceptions, but that's a general idea of how a traditional IRA. All right, we're going to talk about the same thing now in a 401k. So a 401k is almost identical in that money goes in, right here, 401k. Money goes in, again, pre-tax. Let's say, again, you could put a lot more money. So let's say you put 20 grand in. And again, you had a really good year. So let's say 4 grand of growth this year. That's a phenomenal year. And now you have 24 grand in there. So in the end, again, it's the same 59 and a half. I'm running out of room. You take the money out, but same thing, a 401k. You tax on the back end. This is a traditional, not a Roth 401k. That kind of works like a Roth IRA. We're getting to that next. So 401k, you're taxed on every dollar you take out, and then it's your money. So these retirement accounts are really helpful in saving taxes while you're working and saving the taxes on the growth along the way. But yes, it winds up you have a future tax liability in retirement. 401ks, keep in mind, oftentimes they're matching or profit sharing. So that is kind of free money that your employer is going to put in, but it isn't immediately free because there's vesting schedules. So vesting schedules, the typical vesting schedule is over a full 5 years. So really in the beginning of your 6th year is when you get to take all that money out. Generally, you get to keep 0, 20, 40, 60, 80, and then after that full 5th year or in the 6th year, you get to keep all of it. Otherwise, what you put in, you always get back. But the employer portion, if you've left in the first 5 full years, you don't wind up getting to take it all. But I would certainly check with your employer because some vesting schedules are different. That's just the most popular one is kind of that 0, 20, 40, 60, 80, and then you're fully vested. Cool. 401ks, another thing. 401ks have loan provision. Traditional IRAs, Roth IRAs, you cannot take loans against the money. But in a 401k today, you can take out up to $50,000 as a loan. You get that money tax-free, but you have to pay that back over time as your income, basically your salary deferral goes to kind of pay that back. So if you took out $50,000, the payment might be, let's say, $900 a month that you have to pay back. I would check with your 401k administrator on interest rates, but generally the interest rate that you're paying is actually going to yourself, not to the bank. So some things to consider. The last thing there is if you leave before the loan is fully paid off, generally that loan is going to be fully payable within a certain time period after you leave. Otherwise, there's taxes plus a 10% penalty because you took it out before, assuming you're not 59 and a half years old. All right, that's a lot. And we've only covered IRAs, 401ks. So the big one is next. Let's talk about Roths. So a Roth IRA, I'm going to draw the same bucket again. So here we are. We got a big, nice bucket. And here's the Roth IRA, and it kind of works the opposite of a traditional IRA or 401k in that money goes in, but you are taxed on the front end. In other words, you make $100,000, you put $5,000 in a Roth, you're paying taxes on the $100,000. It's like you put $5,000 and you went and bought a couch. Couches aren't pre-tax money, just like Roth IRAs are not pre-tax money. So money goes in. Here we go. $5,000 goes in. Again, it grows by 1,000 to 6. You say, great year, fantastic. Again, investments in there can go up and down. We're just talking generally. Over time, hopefully, it grows and grows and grows. And in retirement, here we go. We're going to take money out of this spigot. Again, 59 and a half is when we can take money out. But since you paid taxes on the front end, well, no, you didn't pay taxes along the way, but all of that growth over all those years, or let's say potential growth over all those years, all of that growth comes out tax-free. Yeah, so as long as you're 59 and a half and as long as you've had the account open for more than 5 years, you get to take that distribution tax-free in retirement. So IRAs is taxable in retirement. Roth IRAs are tax-free generally in retirement. So oftentimes a good financial advisor, if you're really paying attention, you want a mix of both. You want some pre-tax money and some tax-free money in retirement. That way, whatever tax rates do through retirement, and let's say you have a year in which, you wanted to buy a new car. And let's say it's not just a new car, it's a really nice car. Or let's say you want to take this really fancy trip. Maybe you take baseline income out of your traditional IRA, and then you take the extra chunk out of your Roth IRA so it doesn't kick you in the next higher tax bracket. There's some retirement planning for you. So Roth IRA, there are no mandatory distributions. In other words, there's no 72, 73, 75 mandatory distributions today, which is awesome. So you could theoretically keep that money in there until you're 80 or 90 years old and let it grow tax deferred all those years. And then the last thing is talking about a Roth 401k. So a Roth 401k virtually works the same way, except the a couple things that are different. One, contribution limits are a lot different. So again, the $22,500 plus the $7,500 catch-up, so $30,000 could go into collectively either a pre-tax traditional or a Roth 401k. Again, you have loan provisions, and at the point where you leave that employer, generally you could roll over a traditional 401k into an IRA and a Roth 401k into your Roth IRA. So pretty cool that these retirement accounts help come tax time. That's a good overview of kind of how these things work. Really, once the money's in there, this is a big point. Once the money's in there, you could just leave it in cash, right? You could not invest it. But the reality is for these types of accounts, they're tax deferred on the growth. If there's never any growth in there, you're wasting your time. You might as well have it in that Wells Fargo account paying 0.15%, right? So the idea is talk with an advisor, really make some prudent decisions around how you want to invest. Even if it does go up and down over time, the hope is if you have a long enough time horizon, you're going to make a whole bunch of money in these accounts. Thanks for watching. This is super fun for me. What we want to do is make sure you keep more of your money. And that's the whole thing here. It's not just about the returns you're getting. It's not just about what you make. It's about what you get to keep at the end of the day. So keep more. Awesome. Thanks for watching. We'll see you soon.